trade war tensions escalating between US and China, geopolitical escalation between Russia and Ukraine. What does it mean for the markets? What do you need to know? Let's dive into it. So first of all, what do I mean by extreme levels? Well, here we have the US fundamental long short, looking at both the gross versus the net leverage. What we can see here on a gross leverage basis, we have gone to the 99th percentile. At the same time, when we look at the Z-score of the 4-week change of net leverage on all strategies, it went from being at a 2-year low during the crash to now literally being at a 2-year high, a change in just 4 weeks. Now, does this mean that the market's going to decline? No, but what it does mean is that this market has already, all of that extra juice and pent-up buying has pretty much already bought. All of those people on the sidelines that were chasing the market have already engaged the market. So the question becomes, what is the fuel for the next advance? Are share buybacks going to be enough? Is it going to be something more that, with retail investors as levered up as they are, where is the next incremental buyer? This continues to fit our thesis that this market is going to have a lot of heavy overhead resistance and very little further upside. We still believe that there is room for a full double top retest, and even a sell-off may be pushed until July. Obviously, we have to get through a very important week because with the jobs numbers coming out and with the ECB statement and ISM numbers, there's a number of things that could wake the stock market up and potentially spur a sell cycle, but there's no technical evidence that that's the case yet. So when looking at this chart, our path remains that this market here can still make a higher high and still can retest the highs. What is my kind of skepticism? Well, first of all, the NVIDIA news had NVIDIA beat. That was the bellwether, the leadership of the AI boom over the last couple of years. And when they come out with an earnings beat and a gap higher like that in the past, that has driven the stock market higher and driven a new buy cycle. Instead, the big money sold the news and this market faded. That immediately becomes a kind of one little check mark for the bears, that in fact there's some distribution already happening up here at these levels. Now again, I still won't rule out another 100 to 200 S&P points upside potential because there is no technical sell signal and the primary trend is still higher. But the risk reward, the asymmetry of the opportunity is getting pretty bad. It's one of these scenarios, in my opinion, where we're going to have 100 S&P points upside versus a potential of a 300 to 500 S&P point drop, if not even the beginning of another bear market leg if the more ominous tail risk emerges. So point being, there's very little benefit of buying here. No new buying in my recommendations at this stage. Now, that doesn't mean you have to panic sell, go to cash or anything yet, but starting to take some profits, lock things in, buy protective puts, all make sense here at these levels. Even collar strategies where you're selling the short-term calls to finance the cost of the puts and just hedge wrap your positions in to allow them to have less volatility if one of these outlier events starts to emerges this week. So let's dive a little bit. Actually, let's touch on volatility before we go to the other assets. First of all, we remain at the 20 level on the VIX. One of my theses as to whether this was going to remain a bear market or not, or whether a new bull market started, is which way volatility goes. If we saw volatility go sub 15 and get back to the 12 to 15 range, those are very typical vol levels that indicate new bull market conditions and less premium for selling insurance and much cheaper to buy downside market insurance. Instead, the downside market insurance has remained quite expensive. While 20 is well off of the highs we saw over the last month or two, it is way above bull market averages where volatility often stays in the 12 to 15, 16 range for sustained periods of time. This continues to be another red flag, in my opinion, about what's in store for the markets. Let's go a little further. The dollar The dollar is down 66 cents, but it's not just that. We're back under the 99 level, back down to the lows from last week, and now looking for a direct retest of that April low. I still will remain in the camp that I don't think that the big breakdown is going to happen here, and that if anything, we're going to get the classic turtle head formation, which is where it breaks temporarily to a lower low just to sucker in a wave of short sellers and or stop out some longs that had their stop losses sitting along previous lows. And I still favor the idea that it's going to actually spend the remainder of this first half of the year far more in its trade range. Now, that's my current hypothesis, but there is no denying that with the failure of the dollar at the 50-day moving average, which happened to be where the 61.8 retrace was, the measured move for a downside decline is all the way down to the 95 level. And while it's not my favorite scenario, it's still a primary downtrend, still very actively distributed, and very quickly I'd have to accept that this path of least resistance and primary trend is dominant if that previous low gives out without it immediately recovering. So let's touch on gold. Obviously, geopolitical escalation, tensions in trade wars. Suddenly, gold is back. Now, I want to draw this descending trend line and look at today's breakout of this zone. Not only has every dip been bought in a Fibonacci zone at the 50-day moving average, but we now have a clear attempt for gold to break out. Is this the beginning of a new move? Absolutely can be. First of all, the bulls have been in control the whole time. At no point have the bears really genuinely started a new bear market cycle. All we had was a correction in a primary trend, which happens all the time during bull markets. And so with this, there is now a bull continuation pattern that measures all the way to 3,650. This is definitely the short-term upside target for it. Now let's talk about oil. Clearly, this Russia-Ukraine situation has now spurred a little bit of anxiety in the oil markets. Brent moved, WTI moved. We're getting all oil going. Now, this is the first attempt to close above the 50-day moving average since there was at least an intraday attempt back on the 21st of May, but and at the end of March. Each time we've broken above this 50-day, it faded almost immediately within days right back down below. But there's a really interesting pattern here. First of all, we got a clear double bottom and a flagging formation that held above fib retracement zones on the tail, which is very customary or typical of a bottoming formation. This is the type of price action that you see prior to a bull breakout. Now, given this catalyst, there are so many people that were short oil that were not paying attention, were underinvested, and were left it for dead, that if there was to be a short squeeze triggered here, we could easily see a $10 rise with zero fundamental reasons behind it. Simply liquidity flows driven by the fact that investor positioning is so lopsided. And we've seen this before, and we could see it again. Watch this closely. Either this fades by the end of the day, or this thing is going to go. You need to pay attention to this. There's money going to be made on oil here. The next thing I wanted to just touch on, nat gas attempting to break out. This is using, actually, let me just look at the UNL. It's not open yet, but if we look at nat gas futures, turning up here, will we see nat gas also potentially rise in this environment is one of those interesting things that we're watching. Uranium is staying relatively hot, but the interesting is the divergence between uranium companies and the U3O8 commodity itself, the yellow cake. And what we've really seen is that the enthusiasm has been in the equities, and we have not yet seen spot prices change. And that's normal because it's a very illiquid market with long-term contracts. It's not meant to be actively traded, and therefore spot prices can take time to react. But the question is, have we seen things fundamentally change in the uranium markets? I still like the idea of buying the dip and playing this, but not. equities themselves are overdone, and you want to be patient on that front. So I wanted to touch on quickly the SOFR futures. We continue. I continue to believe that this is a buy on dip. I believe that the Fed is executing policy error, and inevitably something almost always breaks during tightening cycles. We just don't know what it is yet and what will be the trigger and when it exactly happens. But when it is, it's still an amazingly asymmetric trade. Very little odds that we're going to have a rate hike cycle resume at this stage. Therefore, you're capped to 50 basis points downside risk. I'm averaging there versus the chance that if this thing really gets going, there's potential for a meaningful upside move if the market suddenly has to price in an extra 100 to 200 basis points of cuts because things are unraveling in some way. It's a very early trade to still have on at this moment, but I still love it. The last thing here, Treasury bonds on the long end, the 30-year, continue to be incredibly weak. And this bounce we saw in the last week has been borderline pathetic. If this is the most the bulls can pull off here, another leg down in the long bond can happen. This is something you can't ignore, because if we're witnessing 30-year yields breaking out and potentially seeing above that 5% on the upside, then it could trigger a market response, because nobody seems to care or think it's important. And there's that old saying I love to say is nobody cares until everybody cares, and then they all care at once. And the question is this going to be a trigger point for things moving forward? That's enough for today's macro outlook. Have a good trading day.